Before I start, I'd like to say a quick thank you to our sponsor, Fidelity International. You can find out more about them at fidelity.co.uk/money to the masses. Hello and welcome to the latest episode of Damien's Midweek Markets, the show where I talk about what's going on in investment markets and what to look out for in the days and weeks ahead. Now, what a couple of weeks it's been since I last recorded this show. We are now in almost unprecedented territory, unprecedented times in investment markets. Just to give you a quick recap, if we go back to around the 19th of February, which marked the high point of the stock market, the S&P 500 is down about 25%. We're now at 2,500 on the S&P 500. Now, that's even with a big bounce yesterday. The FTSE 100 by comparison is down 32%. We broke down below, 7,000 was gone ages ago, 6,000 was gone ages ago. We're down below 5,000. The DAX in Germany is down at 8482, which means it's down about 38%. You can just take these numbers and put them around the world. Globally, we're seeing markets fall between 30 and 40% from their highs. We've seen the 10-year Treasury yield plummet, and in fact it crashed down through 1%. It actually went below 0.5%. So we're seeing bond yields at historic lows, but we've seen a rebound. This is something that's very interesting, that sparks almost the next leg of this crash that we're witnessing, that it will get people understandably worried because there's likely to be more downside before we get the sort of upside and the sunshine. But what it means is that this in stock markets has been the fastest bear market on record, that's ever. So we're talking about faster than the financial crisis back in 2008. We're talking faster than the Great Depression back in 1929. It's taken the market a fraction of the usual time to fall 20% or more across the board. And in fact, if you take the first 3 months of this year, they are the worst 3 months on the FTSE 100 since the 1720 South Sea bubble. So that just shows you how unprecedented what we're witnessing in markets is at the moment. We started off with a fairly orderly sell-off. So if we go back to the last video, we started to see bonds hold up. We saw defensives outperform other cyclical sectors. That meant REITs, utilities were holding up better than things like financials. And we've started to see the cracks. In fact, in the last week, those cracks have widened. And we've started to see defensives actually underperform. We've started to see the bond market show some worrying signs. In fact, we saw the 10-year US Treasury yield in the last few days actually blow out to about 1.2. That's an enormous rally. It doesn't sound like much, but it is. And what's happening is the scale of the coronavirus outbreak and the economic impacts and implications are now being understood by markets. Because in the last 2 weeks, you have to remember, we've had almost unprecedented stimulus as well at the speed that is matching what we saw back in the financial crisis. We've had 2 emergency rate cuts by the Fed. We've had the Bank of England have an emergency rate cut. We've seen quantitative easing start once again in the US, and that is likely to continue and be increased going forward. We're going to keep seeing other measures by other central banks. We've seen fiscal stimulus from the UK in particular, and there's even talk of helicopter money. So the US giving up to $1,000 to every person in America. That is the sort of nth degree when we get to fiscal policy and stimulus, just giving away free money. So almost riding out on a helicopter, dropping dollar notes to everybody, hence the term helicopter money. That is the extreme version of fiscal stimulus, and that shows you where we've got to, because we didn't actually do that even in the financial crisis. So what we've also seen is strain in liquidity in markets. So the Fed had to intervene in the Treasury market to keep it functioning. We've started to see bond markets start to wobble. We've seen signs of stress. We've seen the yields and the spreads actually expand. And that's because if you think about it, with all the businesses out there, the small businesses, the medium-sized businesses, and even the larger ones, they're struggling now to meet their costs. They're seeing, because of forced quarantine measures and dips in demand from consumers, they're struggling to drive enough revenue to meet their costs. And that means they're likely to default on their loans, which for corporate bond funds and high yield bond funds in particular is extremely bad news. And so what we've seen is the bond market in the last week start to show signs of unraveling, almost a bubble in the bond market that we've had starting to pop, a bit like we've seen in stock markets. And that is normally what we see in a really extreme environment like this. So if you go back to the financial crisis, we got to a point where equity markets and bond markets collapsed at the same time. I know 101 of investment diversification is meant to say that when equities fall, bonds go up, they're meant to, and vice versa, and they're meant to diversify your portfolio. But we are in an environment now where it's all about liquidity and people are selling everything, including gold. So gold has been tumbling. We're seeing bonds tumble, havens are tumbling. So you will look at your portfolio and will be wondering why it's going down 2, 3, 4% a day, despite the fact it's diversified across bonds and equities. And that's the reason. It's the level of panic has set in. So don't be surprised if we start to see some strain on some bond funds during this environment, and even maybe potentially some gatings. We've seen the gatings appear on property markets already. So there's been a number of funds that started to close their doors to investors. And we saw that, if you remember, in the aftermath of the Brexit referendum, when liquidity issues meant that the funds had to close. Now we're seeing a similar thing, but it's not just about liquidity, in fact. It's about the valuation of the assets themselves that have been held in there in the light of what's going on with the coronavirus outbreak and the impact it will have on the value of those assets and office blocks. So we're starting to see precautionary measures being taken. So you're likely to see gatings of funds in this environment because we're in a very extreme environment right now. If you want to get a handle on the level of fear that's out there in markets at the moment, if you look at the VIX, the VIX, which relates to, basically used as a quasi-fear indicator for equity markets, in particular the S&P 500, we're not just above the old levels if you look back on these videos talking about 15 or now even above 30, which is a high level. We're constantly at a level above around about 70. That is so extreme. It almost makes markets uninvestable. And with bond markets, we're seeing the volatility pick up there as well. And of course, that is really what the Fed is worried about when you get a volatility in treasury markets and the yields go up and down. Because if you think about it, if you think of investment markets like a tower, so the ground floor, the foundations are things like the haven assets like treasuries, like gilts. If they start to wobble violently, then what happens to the top of the building? Well, that wobbles even more and eventually completely collapses. And that's why central banks are now worried about a potential collapse or sell-off in bond markets, because the implications for everything else are even more severe. So, well, the message is things could get a lot worse before they get better. And you'll even have noticed the pound has tumbled. Now the pound is not only back down below $1.30 that is, it's down below $1.20. It's actually $1.18 as I make this video. That is below any level we saw in the aftermath of Brexit. And the reason this is happening is because the dollar is a haven asset, and it's the one that everybody is trying to buy right now. So it's the one haven asset that is basically outperforming. Everybody's liquidating gold, bonds, equities, pretty much anything to get their hands on dollars and keep hold of those dollars. And that's what you saw in the financial crisis. It's a pattern that's being repeated now, and it's likely to continue for a period of time until we get to the peak fear. When will that be? Nobody really knows. But to take an historical precedent, on average, if you go back and look at past bear markets, it's taken about 206 trading days on the Dow Jones to get out of a bear market, and on the S&P 500 it's 146 days. The overriding message is patience. We would love this to rebound overnight, but if we look back at things like the financial crisis and the Great Depression, then it suggests it's unlikely to happen, because you've got to think about we're in the early stages of the coronavirus outbreak in the UK, the US, and not all of Europe is under quarantine even. So we've got a lot further that we could go. So don't be surprised if things get a lot worse before they get a lot better. So what to look out for in the days and weeks ahead? Well, it's all centered around coronavirus. Don't get too bogged down on all the headlines and try and take a break from looking at your portfolio's value over and over again, because it's going to whipsaw over the coming days, weeks and even months. If you want to look at anything to get an idea what's going on, keep an eye on the VIX, because you want to see that start to tumble back down from 70, heading back down towards 20. That's the level that's an historic average. If you Google HYG, then you can keep an eye on what corporate bonds are doing, particularly high yielding bonds. So if you start to see that tumbling, that means the bond market is still having, or the corporate bond market is under a lot of strain. Of course, the 10-year US Treasury yield, keep an eye on what's going on there, because we need to see the volatility drop on the swings of the 10-year yield, because that, like I said, imagine that image of the skyscraper and the foundation shaking. We want to see that calm down. And of course, you can keep an eye on equity market levels just to see what's happening. But we're going to see swings of 5 to 10% a day for a while now, I think. We've got to get used to the idea. We saw it during the financial crisis. It's unlikely to end just yet until we get some more clarity over the coronavirus. And of course, keep an eye on all the fiscal stimulus and the monetary stimulus from all the central banks. We're going to get a lot more headlines, but it's a case, there's not a lot you can do right now. Cash is the only haven at the moment, but of course, if you cash out, you are going to crystallize losses. So it's something to bear in mind. Often the best thing to do in an environment like this is absolutely nothing at all. So that is it for this week on Damien's Midweek Markets. As ever, you can contact me. Damien at moneytothemasses.com is the email address. Money2themasses with the number 2 is the Twitter handle. And do join our Facebook group where people are talking about investing all the time. And if you've got any worries or anything like that, you can share them with people. And of course, we are on Instagram, and do subscribe to our YouTube channel.